Good afternoon, everyone, and welcome to the 2025 Coronation Asset Management webinar on exploring infrastructure funds as an alternative investment opportunity. Today, we are joined by professionals across the industry who will share insights into the infrastructure financing markets, the prevalent opportunities, and the key learnings that you and I will gain to make sustainable investment decisions. I am looking forward to the conversation and I hope you are. To kick off this webinar, I will invite the Managing Director and the Chief Executive Officer of Coronation Asset Management, Mr. Igo Biose Ike Imokwede, popularly known as Igos, to start us off with the opening speech. Igos, please.
Thank you, Susan. Very kind of you. I trust that I'm audible. Good. So good morning, everyone. I am Ike Biose Imokwede. To my distinguished guests, colleagues, and valued partners, I say welcome. So I'm Managing Director of Coronation Asset Management Limited. It's my great pleasure to welcome you today to the webinar on exploring infrastructure funds as an alternative, exploring infrastructure funds as an alternative investment opportunity. Thank you for joining us today. Your participation reflects the shared commitment to advancing the informed investing and to driving conversations that connect capital innovation, and sustainable economic growth in Nigeria. At Coronation Asset Management, our purpose is quite clear. We aim to help investors make confident, well-informed decisions and to deepen understanding of emerging opportunities that build both the wealth and impact. Platforms like this embody that mission. They create space for meaningful dialogue, promote financial literacy, and highlight investment classes that might deliver long-term value, not just for portfolios, but also for the economy at large. Historically, Nigeria's investment landscape has been anchored on familiar products, equities, bonds, and money market instruments. These remain vital. Yet, in a rapidly evolving economy, the case for alternative assets and alternative investments, particularly infrastructure funds, has never been stronger. Infrastructure underpins the productivity, inclusion, and growth. It is also an asset class that aligns with our clients' search for yield, stability, diversification, and of course, social value. Today's session has been carefully designed to explore how investors can participate in this space, understanding the nature, the structure, and the risk dynamics of infrastructure funds, and of course, the role that they play in national development. We are extremely privileged to host a distinguished panel of experts whose perspectives span entire infrastructure value chain. Mr. Chido Oyilimba, Head of Origination and Structuring at InfraCredit, who will discuss how credit guarantees can unlock long-term capital for infrastructure. We have Mr. Victor Samuel, Managing Associate at Udoma and Bello Osage, who brings deep insight into legal frameworks that support infrastructure financing in Nigeria. Mr. Bolaji Femi Ishola, Vice Chairman of VTT LNG Limited, who will share practical perspectives on operating and financing infrastructure projects. And of course, Mayowa Ikotu, who heads the Coronation Infrastructure Fund, and who will discuss how we at Coronation are applying disciplined fund management to bridge Nigeria's infrastructure financing deficit. Collectively, this panel brings together expertise across infrastructure development, finance, and fund management, offering both practical insights and strategic foresight. By the end of this session, I trust that you will have a deeper appreciation of how infrastructure funds can enhance portfolio resilience while directly contributing to national progress. Once again, thank you for joining us and thank you for choosing Coronation, your trusted partner in creating, preserving, and multiplying wealth with purpose. Thank you, Susan.
Thank you very much, sir, and thank you for your opening speech. Now we will take the keynote presentation to be presented by Mayowa Ikotun, the Group Head of Coronation Infrastructure Fund. Mayowa is a highly driven investment and infrastructure finance executive with over a decade of cross-industry experience spanning asset management, banking, lending, and engineering. He currently heads the Coronation Infrastructure Fund, where he leads fund strategy, deal structuring, investor relations, and regulatory compliance while spearheading capital raises for large-scale infrastructure investments. His career trajectory includes serving as Chief Investment Officer at Ava Global Asset Managers, where he oversaw the setup, structuring, and execution of the Ava Infrastructure Fund. In this role, he successfully coordinated the filing of a 200 billion naira program with the SEC and completed a 20 billion naira Series 1 raise. Under his leadership, Ava's Global Asset Managers AUM and client base grew significantly, alongside major automation and digital transformation achievements. With a solid technical foundation in civil engineering, complemented by an MBA and senior management training, Mayowa brings a rare blend of analytical rigor, commercial insight, and operational execution. His leadership ethos is rooted in performance, innovation, and value creation, qualities that have consistently translated into significant business growth, investor confidence, and market impact. But let us welcome Mayowa Ikotun for his keynote presentation. Mayowa, you have the floor, please.
Thank you very much, Susan, and thank you everyone for taking time out to join the presentation and this webinar. Just give me a few minutes to project my presentation. Susan, please confirm you can see my presentation.
Yes, it's very clear.
Okay, thank you very much once again. So I'll just start off from where I was entered us. Quite a lot of investors and many participants on the call this afternoon are very familiar with traditional instruments, equities, fixed income instruments, treasury bills, which are giving attractive investment over the past 2 years, and so many other similar traditional investments. However, just like humans, we are always looking for more. What sells? What is the next thing? What else can we do? What else can benefit me? What can increase my wealth? Right? So due to this, we've seen investors invest in real estate, and we have to say real estate investment in the country of recent have been very innovative. We've seen the huge drive in investment into short-let apartments and various kind of assets. We've seen increased investment also in the REIT, and also some investments around tokenization and monetizing real estate assets. We've also seen people invest in private equity. We've seen a lot of investment in cryptocurrency, and the call for this to be regulated by regulators, which quite a lot of regulators across the world are currently looking at. Amongst these alternative assets, we have infrastructure fund, which is what we are talking about today, to provide more context on what it is and how investors can benefit. On infrastructure fund, this gives investors opportunity not to only earn attractive returns, but to also see improve in development in the country, and also for all of us to see the Nigeria of our dream. So what do I mean? We all go on various platforms to say, oh, the road within the country is bad. There's not enough transportation infrastructure. Oh, I could probably not be living in Lagos if there was very good rail systems, airport infrastructure, and all this. But these are not happening because they are. It requires quite a lot of heavy funding, and currently we are not there. So what Infrastructure Fund does is to play actively in all these infrastructure across various sectors. And you investing in this allows you to see the road you plan on a daily basis to be as effective as you want, and also increase in various infrastructure development in the country. So just like I was saying, so what has Infrastructure Fund done, or what is it doing? What it has done is to make these infrastructures into an asset class. So what do I mean? So the road you are seeing, the water the clean water we are all yearning for, the airport infrastructures we are looking at, the increase in power supply we are asking for. What this has done is to make these an asset for us to invest in. Yeah, you're not investing directly, but you're investing through the fund to ensure we continue to block these infrastructure gaps. And for the infrastructure fund, right, we invest in a project depending on how the project is structured two ways. Either it's a greenfield project or it's a brownfield project. So when I say greenfield, what does this mean? It's a new project that's starting from scratch to execute the project. While brownfield, the project is probably existing and probably requires some expansion, benefit of people that currently make use of these assets. And for the fund, we invest in this project either as senior debt, subordinate, mezzanine, and some time we could invest as equity. But in as much as the project is being able to be completed within a agreed time frame, and for investors to continue to get their consistent returns. So why is this very important? We might ask, some will say, what's the business? Why do we need to care? Why do I need to invest in anything that has to do with road? That should be the government. What's the role of the government? And some of us are we are critics of the government, saying all these monies they're making, why are they not doing the roads? Why is there no railway? Why is there no water? Why we don't have light and stuff like that, right? But we need to look at the numbers. According to ATTID, in the continent, African continent, there's currently a huge infrastructure gap, right? And for us to block this gap, there needs to be an investment of at least $170 billion annually, right, to block this gap. And Nigeria operates within that sector. And going to my next slide, we could see that out of this $170 billion, Nigeria alone, we need to invest at least $100 billion annually so that we could solve these huge infrastructure gaps, which means over the next 30 years, we need to invest at least $3 trillion. This can't be done by just governments or the federal government of any country within the continent, right? This needs participation from the capital market and from private individual. But how did we get here? What has caused this huge infrastructure gap, right? First, funding constraints. Like I said earlier, these projects are huge projects that require quite a lot of funding, right? I would say again, when the government should plan and make and set aside funding to execute this, but we need to also be mindful. There are other things that governments are also doing. Salaries need to be paid, and so many other things, right? So help needs to come in place. We can't take away the fact of corruption and mismanagement. There are some situations the project should be executed, probably there's even available funding, but because of the security concerns within those regions, there happens to be a lag into when these projects can start or can be executed, and it affects this project. And at the long run, probably project sponsor or the contractors abandon it, and we continue to deteriorate. Then the long bureaucracy within approval processes, depending on the project where it lies, either the federal or state government, then the consistent inability for us to even maintain these infrastructural projects when it is concluded. So what are we saying in essence, right? So if we're able to invest in all these projects, what's our benefit? So we just highlighted few projects, right, across various sectors. Let's take road network, for example. As a student, I remember traveling Lagos-Ibadan Expressway. It was not a matter of dodging pothole. It was a matter of choosing the pothole you want to enter. But what do we have now? You could go to Ibadan today and come back today, probably an hour, 30 minutes journey. That is what an infrastructure fund or investing in infrastructure does. There's this Lagos Calabar Coastal Highway project currently ongoing, massive project. Aside from making travel time very easy, it opens up many areas. Like I was saying earlier, I could probably now go and sit down in Ondo State and come to Lagos every day, right, to do my work and go back, because I know probably it takes me 1 hour or 30 minutes to get to it. So it opens more areas along this coastal road. It creates job opportunities, more businesses. Currently, there are a lot of SMEs and various other businesses along construction currently getting projects, and it's going all around. Abuja, Kaduna, Kano Road, quite a lot of roads that we can start looking to. Then let's look at also rail infrastructure. Lagos is currently doing massive rail infrastructure. There's blue line, there's red line, and then there's been talks of a green line along the Lekki axis. Right? What is this doing? Opening up many spaces, reducing travel times, and making it easy to commute from one place to the other. This is what investing in infrastructure does. If you go to ports and maritime, recently the government had said the major ports within the country is going to be renovated. This opens the country up to more investment and more investors, right, to come in. It allows you imports more, exports more, makes our trade to start buzzing. This is what investing in infrastructure. If you look at energy and power infrastructure, yes, we are not where we want to be as regards having 24 hours power supply, that you don't need to think and structure where you want to iron your cloth and all that. But we have to also allude to the fact that there have been improvements. And this improvement is as a result of investment that has been done into this sector. So look at Shiroro Hydropower Station, the Zungeru hydroelectric power plant currently being constructed, and the Siemens power plants, right, currently being constructed. All this, if concluded and added to what we are currently enjoying, increases transmission and what and the power we are able to generate and what we all can benefit. Then look at urban and development housing. Currently, across at least the major urban areas in the country, Lagos, Abuja, Port Harcourt, I doubt you can walk a few kilometers without seeing either an estate being constructed or a new building being constructed somewhere. These require quite a lot of funding, right? And this is what is helping to solve the housing deficit. I'm sure quite a lot of us wants to get somewhere to buy, somewhere to stay, and somewhere comfortable. But investment needs to be done into this. Like, many examples that we can start giving, but we highlighted few mass housing projects that are currently ongoing. Finally, I'll touch on ICT and digital infrastructures, right? That is why we're able to have this conversation. That is why we're able to join via Zoom. That's why you're able to have virtual meetings. That's why some of us are currently enjoying work from home, because of the huge investment that has been done into ICT and digital infrastructure. It allows us to explore things that are not that are unimaginable, right? It allows us to open up so many things. It's key investment into our ICT and digital infrastructure. Like some of us will say, before it used to be, oh, water is life, but now saying is data is life. So, but for data to be live and for it to be effective, for you to hear me clearly, for me to be able to speak to someone out of this country, investment needs to be done into these various infrastructures. So how are these infrastructures, how are they funded typically? First, public finance, that the government, either state or federal, from their various allocations on a monthly or annual basis, set aside funds to invest in these infrastructure projects and get some they can start end to end and conclude. Some they break it down across milestones that go from various years budgets before they could conclude. We have the PPP, public and private partnership, also on some projects, right, which has been able to execute some projects like the Lekki Deep Seaport and so many other projects within the country. We also have the DFIs financing some of these projects. I'm sure some of us would have heard how IMF finance this project, World Bank finance this project, or even if you go to the project site, you'll see their logos and write-up on them financing this project, because what they're also trying to achieve, one is to reduce the infrastructure deficit, and also for the benefit of the citizen of that country to benefit from that project. So we've seen them come and play heavily within this sector. Then there comes the domestic capital markets, where the infrastructure fund work and other investment vehicles. For example, we have the Sukuk and green bonds. I'm sure if you travel interstate or even some places within some states, you will see, oh, this road was constructed using federal government Sukuk 3, Sukuk 2, and stuff like that. So these are what the capital market is doing to reduce this deficit. Also, the infrastructure funds we've been talking about is a capital market product, is a capital market instrument that also invest in various infrastructure. We also have the sovereign wealth funds and financial institutions. So financial institutions, your typical bank, insurance firms. For banks, it's by giving facilities to this project sponsor to help them execute this project. So like I was saying, just expanding on our role within the capital market. The last Sukuk and the government raised, it was supposed to be for 300 billion, but it was oversubscribed by 735%. And the reason is there were clear communication, and people are beginning to understand that these funds are going into key infrastructure that affect you and that affect everyone. Also, the green bond that was issued was also over 833% success subscription. And these are instruments that was structured within the capital market, marketed within the capital market, and capital raised within the capital market. And now the funds are currently with the government, and they're able to deploy across various infrastructure assets within various sectors of the economy. So why infrastructure funds? I've stated it, so now we understand why infrastructure is important to us, it's important to everyone, right? It makes things and life easier for every one of us. So infrastructure funds is an instrument investing in these assets that makes life easy for you, that makes life easy for me. So if you look at how it is, first, they are collective investment scheme, right, that is registered with the Securities and Exchange Commission. They are structured first as a program. Then after the Securities and Exchange Commission has approved the program, we come out in various series, depending on the underlying assets of various infrastructure projects that we have, right? So that we are able to block this infrastructural gap. So when we issue a series, we come to the market, we come to investors like many people on the call this afternoon, raise the capital. Right. After raising the capital, we then invest in the infrastructure project. Then the incomes generated from the infrastructure project are then distributed to all the unit holders within the fund. So for infrastructure funds, there are three typical types. One, it can be structured as a debt fund, can be structured as an equity fund, or hybrid of both. So our typical investors, PFAs, qualified insurance investors, sovereign wealth funds, high network individuals, and development finance institutions, insurance companies, and others. So I'll just move to why infrastructure funds are attractive. Like I said and I've mentioned, they have strong cash flows because these projects that are being invested in, they're expected to bring quite a lot of return based on how the projects are structured. Also, while we are financing, we come to an agreement on how the repayment will be made clearly, but not impacting the project or the project sponsor, because these funds are given to these project sponsors for a longer term as compared to what your regular commercial banks would typically do. So it also allows you to beat inflation. Right, because the rates are benchmarked against SGN bond plus premium. And also we, infrastructure fund owners, like Coronation Infrastructure Fund, we always strive to outperform what we have promised you, because our incentive fees are also on how well we do. So our aim is to give you the best and maximum return we can get on any project. Then competitive returns, resilient demand, and long-term horizon. Like I said, it allows the various infrastructure project owners to take their time to do quality work and not be in a rush on making repayment. So, but it's well spread across a very long tenure. So on risk and mitigants, right? These are the risks we look at while investing in so many of these projects. But we don't need to worry yourself, and that's the work of the infrastructure fund team. And even after we have done all our internal reviews, but we still get external legal opinions, which is the work of people like Victor on the call that was speaking to us and taking some questions, right? To also help us do enhanced due diligence to ensure all the risk per project, right, have been totally eliminated or thoroughly mitigated. So we have market risk, construction risk, supply risk, operation risk, political risk, legal risk, funding risk, and credit risk. So all these risks per project, we check what they are and provide enough mitigants. Some mitigants might include us adding the mitigants to the structure, and some as CPs that will ensure that these projects are completed, and even after completion, the expected returns are duly achieved. So when it comes to regulatory, first, the infrastructure fund or infrastructure funds are instruments within the capital market. So it sits with the Securities and Exchange Commission. Like I said earlier, while registering the program, you get the approval from the Securities and Exchange Commission, then per all the various series that you would issue across the number of years, the commission also approves them. So, and the fund manager sits, is regulated also by the Securities and Exchange Commission. So it end-to-end with the Securities and Exchange Commission. Then their quarterly reports, their spot checks, and our quarterly reports also capture the investment we have made, the sector, the company, so that even the Securities and Exchange Commission are fully aware of what we are doing and the returns we are giving to investors. So there's transparency on the regulatory part. Then what has regulation also done? The Commission has also clearly stated clear rules on how infrastructure funds should operate and where we should invest and all that. So it's clear on the regulatory part. But aside from the infrastructure fund and the Securities and Exchange Commission, some of these projects that we engage are also under one regulation or the other. Then some of the investors that we also engage are also under regulations that we have to abide to. For example, I stated earlier that PPP are part of those investing in various infrastructure projects. That's all thanks to the ICRC Act. And we've seen quite a lot of projects being opened up because people are able to get concessions and take on this project. That's what ICRC do. The PFAs under PENCOM and the insurance companies under NICOM clearly states what and how they also should invest in infrastructure funds as an asset class. And these just highlight few of key rules across the various regulatory bodies that we try to align with. So, like finally, or let me say in closing, on the fund manager, so currently I've spoken a lot about infrastructure funds. So in Coronation, we also have a Coronation Infrastructure Fund. And the fund manager of the Coronation Infrastructure Fund is Coronation Asset Management Limited. And we do a lot of work, like my MD has spoken earlier, to ensure we give maximum return to our investors. But aside from Coronation Infrastructure Fund, we have other products: the Coronation Money Market Fund, Coronation Fixed Income Fund, Coronation Balance Fund, the Coronation Fixed Income Dollar Portfolio, the Coronation Dollar Fund, and the Coronation Fixed Income Fund. All these funds are public funds, regulated and registered with the Securities and Exchange Commission. We are also rated by two rating agencies, Augusta & Co. and GCR. We have an A- with Augusta & Co. and an A from GCR. So aside from this, we also pride ourselves in some of the awards, right? We have won due to our ability to execute on client mandates and what we've been able to do in ensuring clients are happy with our services. But aside these awards, the Coronation Infrastructure Fund is listed on the Nigerian exchange. So investors are able to buy and sell, buy more units into their portfolio or even sell from their portfolio, because that platform gives access to more liquidity and transparency of our operations. So the Coronation Infrastructure Fund is a 200 billion program. We are done our Series 1. We raised 8.79 billion at the time, and that made us the IF that was able to raise the largest capital raise for a Series 1 of an infrastructure fund within country. As of end of September, the gross asset value is 9.5 billion. And the net asset value is 9.46 billion. And over the span of like a year, we paid circa 1.4 billion to our various investors in dividends. So we pride ourselves in our ability to continue to build our pipeline. So currently we have a robust pipeline of various infrastructure projects that we are reviewing and currently financing. We have a dedicated and strong team and ensure proper project monitoring and portfolio monitoring. Our performance, I think, has been very great. H1 2025, we delivered a return of 24.18%, which is 3.17% above our benchmark. We ensure we abide by clear corporate governance and also very transparent in all our dealing and everything we do. So, for example, like the fund now, we are regulated by the Securities and Exchange Commission, and because we're also listed on the NGX, we are abiding by all their rules and regulations. Then we continue to ensure market differentiation in everything we do. So, in conclusion, to close my presentation for this afternoon, what does investment in infrastructure fund gives you? One, it gives you diversification. Two, it gives you stable cash flows. And three, it allows you to hedge against inflation. Thank you. That would be the end of my presentation. I would hand over to Susan now to assist in coordinating questions. Thank you.
Thank you very much, Maiwa, for a very insightful presentation. It was very detailed, speaking about infrastructure and assets, the benefits of infrastructure fund, and knowing that whatever we put our money into, it finances the needs of the country or even the individual. So thank you very much. Just to announce that the presentation will be made available at the end of the webinar. So while this webinar is going on, if you have any questions, please drop them in the Q&A box in the chat section. If you can see it down there, just drop your questions. We'll attend to it during the course of the webinar. For now, we want to take a poll just to answer for you guys to be part of this webinar as well. So it will come up on the screen now. So the poll is up. So you can vote just to answer the questions that are there. The first question speaks to how soon are you looking to make your next investment in alternative assets such as infrastructure fund? So it's just a single choice question. The next one, what percentage of your current portfolio is allocated to alternative investments? And the last one, would you like to receive a personalized review of how infrastructure funds could fit into your portfolio? So these questions are targeted at the participants we have on the call to allow us to develop specialized portfolio plans for the participants. So please answer the questions so you can be a part of this webinar as well. We look forward to receiving your answers so that we can reach out to you individually. So please ensure to answer it. Thank you very much. So while that is going on, I would invite the panelists. So we have 3 professionals in their fields, and they will ask, just engage them ask them a few questions relating to what Maiwa has said, and even beyond, how they have their work and how it has impacted infrastructure funds. And then they will just share, their insights with us. The first person I will be introducing is Victor Samuel. He's a managing associate at Udo, Udoma, and Bilo Osagi. He has advised on major infrastructure and project finance transactions across Nigeria's energy and industrial sectors. Victor Samuel, welcome. Good afternoon.
Hi, good afternoon. Good afternoon, President. Very happy to be here.
Thank you very much, Victor. We're very happy to have you. The next person I will invite is Chido Onyelimba. He's the Origination and Structuring and Infra Credits. Chido Onyelimba serves as Head of Origination and Structuring and Infra Credits, driving landmark infrastructure financing deals and leading the growth of its multi-sector guarantee portfolio. Victor, please, can we see you? Sorry, Chido, can we see you? Can you turn on your video?
Yeah, I've done that. Okay. The virtual background is still loading.
Okay. Good afternoon, Chido.
Hi, Susan. Good afternoon.
And welcome.
Chido here. Thank you.
Welcome. Our last but not least panelist is Mr. Abolaji Femishola. He's the Chief Executive of Tranergy & Co., a merchant investment and advisory firm where he leads high-value energy, infrastructure, and financing transactions across Africa. Mr. Abolaji, good afternoon.
Good afternoon. Thanks for the opportunity to be here. Thank you.
Good afternoon, and welcome. Thank you very much. So the poll is still up, just for you to answer the questions while we go into the panel session. So my first question is regarding the infrastructure gap. So Chido, this question is for you. Nigeria's current infrastructure stock constitutes only 30% of GDP, far below the World Bank's benchmark of 70%. Additionally, the African Development Bank estimates that Nigeria requires around 100 billion annual infrastructure investment over 30 years to bridge its infrastructure gap of about $3 trillion. In the Nigerian context, what do we mean by infrastructure gap? How did this gap widen over time? And in what ways can infrastructure investments help bridge this gap and drive economic development?
Thank you, Susan. And good afternoon, everyone, once again. Just permit me 1 second to acknowledge Ike, who gave the keynote speech, and Maiwa for the very detailed presentation that provided a lot of insights as to where we are as a nation in terms of infrastructure development. Like you rightly noted, we are significantly behind the benchmark set for emerging markets. Over the years, looking at the rate at which our population has escalated relative to the required amount of investment into the sector, the gap has invariably emerged. At InfraCredit, we were established in 2017 by the Nigeria Sovereign Investment Authority. In 2016, we commenced operations in 2017 to bridge that gap, the infrastructure gap, bridge the gap in terms of market confidence, convincing institutional investors to look more into the infrastructure asset class rather than the traditional government securities and traditional investments in bonds and equities. Since then till date, we've successfully admitted additional investors such as the African Finance Corporation, Infraco Africa, and as well as domestic institutional players like the pension funds and insurance companies into our ranks. We've expanded our balance sheet to well over $200 million and can support over 5 times that in infrastructure assets. To date, we've via the capital markets and certain financing from the Bank of Industry, we've mobilized a little over 300 billion naira and are looking to scale that over the coming years, working with infra funds like Coronation and the others in the market to bridge this gap. Thank you. I'll stop here.
Thank you very much for the response, Victor. Sorry, Chido. So the second question, let's just discuss what infrastructure fund is. So my question is to you. What makes infrastructure funds an attractive alternative investment option, particularly in this Nigerian context? And then who are the main investors in infrastructure funds? I know your presentation spoke to some of this, but if you could shed more light on this. Thank you.
Okay, thank you very much, Susan. Like I said during the presentation, first, infrastructure funds. Okay, probably let me not say collective investment scheme because probably people don't know. Collective investment scheme is same as mutual funds, right? So that means we all come together, we put funds together, and invest together, then enjoy the returns together in just very simple terms. So that's collective investment scheme. However, but for funds like infrastructure fund, they are closed end, not open end ended like the money market funds, the dollar funds, and the likes that we have. So what this means is, like I said in the presentation, we register a program, come for series. So if you come for series 1, and we come out to the market to raise funds, then we have a closing date. Then those are investors for that series. Then we invest in various infrastructure projects, right? So who are the investors that we go around to meet to invest when we come out to raise various series? One, the PFAs. They are one of the largest investors currently in infrastructure funds. Then there are people we call the qualified institutional investors, under which the asset management firms for the insurance companies, the trustees, investment banks, PE firms, quite a lot of them, right? We have the DFIs that can also then invest. Then we have HNIs that can invest. However, because the fund is also listed on the exchange, the NGX, retail investors are also able to participate from when the core investors are exiting their position. So retail investors are able to buy those units and also benefit from all the attractive return and the impact we are trying to make to reduce the infrastructure gap in the country.
Thank you for that. But just to piggyback on that, could you shed more light on how infrastructure funds are structured and the specific role they play in addressing the infrastructure gap?
Okay, thank you very much. So in the structure, so first on governance, or let me list all the transaction parties, right? First, I mentioned the fund manager, which I've spoken deeply about. We also always have the trustees on the transaction that protect the interest of various investors, right? We have auditors that audit our books on an annual basis. Then on corporate governance, we have investment committee that always comprises of well-experienced professionals within various sectors of the economy that gives their input, helps in project review, and ensuring that the projects we are investing in sticks and aligns with the objective of the fund. Then additionally, there's always an advisory board that comprises of key investors and also experienced professionals that also provide that fiduciary function. Then aside from that, then there's always the fund management team that is always structured across portfolio management, in project monitoring and review team, And then there's still the research part, right? That's on the team part, and that's the structure. Right. And your other question on specific roles we play in reducing the infrastructure gap, right? And just like I mentioned during my presentation, in simple time, what we're trying to do is when we leave our house to go to a place, what is making the path we are committing to the place we are going is small. When we're in our house, we try to switch on power, there's power. When we go to the airport to travel, we enjoy the facility. So that is what we are trying to ensure happens in the country.
Thank you. That's provided a detailed knowledge of what infrastructure does, what infrastructure fund does, and then how we helps us to meet our needs, even as individuals and as a country. My next question is for Mr. Abolaji. As a project sponsor, how have infrastructure funds in Nigeria done enough to support projects? So projects that you have done and concluded, or the ones that are even in the pipeline. Mr. Abolaji. Okay, maybe we'll just come back to him. So Chido, my next question is for you. Speaking from your role as head of structuring and origination at InfraCredit, what key risks do you typically look out for in transactions? And what are the common mitigation strategies that you adopt?
Thank you once again, Susan. I don't think risks are peculiar to infrastructure. With every investment, there are risks, and there are a plethora of them. I think to make it simple for people to follow, we usually break it down into greenfield and brownfield type projects, because the risk profile of both asset classes are somewhat different. In a brownfield asset, it's an operating asset, it's largely de-risked. The contractual arrangements are established. The entity is operating. It can easily obtain an investment grade rating if the project is delivering to it according to its mandates. Usually, when we talk about infrastructure and projects, what people have in mind are greenfield projects. And for those, the characteristics are slightly different, because now you incorporate construction risk. Looking at how volatile the market is, usually what happens are projects start and somewhere along the line is abandoned. I think if somewhere along the line as a people, we go through this cycle. If you look around you, there are several abandoned projects. And that heightens the overall perceived risks on infrastructure generally. Therefore, in classifying what is greenfield and brownfield, what usually stands out is the construction risk, that view on whether the project ultimately is completed. Now, given the essentiality of the service being rendered, usually for the infrastructure asset buckets, there is usually no question around that essentiality piece. To my last point around the asset class being inflation hedged, that's because the service being rendered is essential. You would eat whether or not the price changes. What would simply change is that the volume of, or the size or the quantity of what you consume would reduce. You would go to hospital whether inflation is at 90% or not. If you fall ill, you require medical attention and you would pay to get that sorted, and so on and so forth. If you look at the various sectors which touch on infrastructure, the essentiality of the service always underpins what you're looking out for in terms of risk. So I won't dwell on the risk. There are a plethora of risk: construction risk, operational risk, counterparty risk, offtake risk, and so on and so forth. I think what everyone usually focuses on is that the project is bankable and the service being rendered by the project is essential. Once you have these buckets ticked, institutional investors will latch onto it and support it. Thank you.
Thank you very much. So I'll just go back to my previous question for Mr. Bolaji. I asked that as a project sponsor, have infrastructure funds in Nigeria done enough to support projects? So whether it's projects that are completed or the ones that are currently in the pipeline, do you think that infrastructure funds have done enough to support those?
All right, thank you very much for that question. Once again, thanks for the opportunity to be here and for making this happen. My experience in terms of infrastructure funds supporting projects in Nigeria has been rather positive. We have seen a lot of co-advising and guidance on our projects. Essentially, we have had an opportunity to engage with them, wherein they've had structuring capabilities on a project, where they've also invested in what you call credit confidence building on projects. And I think the likes of the domestic infrastructure fund, we're beginning to see a lot of capacity on that side. They've literally pretty much taken over the role of what the external infrastructure fund used to play previous to the downside in the market in the last 3 to 4 years. Haven't played that role. We're seeing a lot of support from that end. The support could be better, very much. We haven't reached where we're supposed to be. I guess their own pot is not as wide as well in terms of war chest. But we are seeing, cross functionalities. We're seeing a lot of support on that end. On the advisory side, on the structuring side, because they're then coming on board with capabilities that would help funds, that will help projects come to maturity, come to a place where they could be funded. I guess generally from the point of project owners, they usually have sometimes technical capabilities, may not have financing capabilities or even just structuring. So the role of the infrastructure fund pairing up with the project owners makes the projects better. There's room for additional capabilities. We're not there. They're not where they are, but they're doing very much to support the market. Thank you very much.
Thank you, sir. And it's good to know that the feedback is positive. But just to add to that, what strategic role do infrastructure funds play in turning pipeline projects into bankable and financeable realities?
Susan, sorry,
Did
say
you
that
get the
again?
question, or you want to take it again?
Yes,
Okay, let me take it again. I said, and what role those infrastructure funds, what role do they play in turning those pipeline projects into something that is bankable and financeable?
I mean, I think that at this point we'll start to pair up the infrastructure funds along with the other support specialist providers in the market, including the credit enhancement businesses, and of course, the other type of sovereign wealth funds that are available in the market today. But we've seen arrangements for early stage capital provision being encouraged in the market. Essentially, that is a key point and an area where the market pretty much struggles with. For many infrastructure projects, the development time can be a bit stretched, sometimes up to 3 to about 4 or 5 years. And this is you hoping that there will be almost zero serious macro issues within those 5-year period. And what is expected, as Chido mentioned, if it's a greenfield project, it might take, the spend is a longer time. If it's brownfield, it might be a shorter time, depending on the type of the transaction. But generally, if you look at that pace, we're beginning to see arrangements where some funds are considering supporting on the pre-development cost side of things. That is a very hard place to for most developers in the market. There was a point very much in this country where pre-development costs just didn't exist. That cost usually comes from the pockets of a would-be a sponsor. And that cash really comes usually from family and friends and people you can put together very early. If we look at what the Minister for Finance said, I think not too long ago, when he was saying that the average, there's just about 5% of Nigerians who have just about 500,000 naira in the bank account. It speaks to the type of the depth of the pockets within the country. So you're not able to access that kind of cash. The only way to look at that kind of cash is to look at, you can look at the banks. The banks are generally not what they call venture capitalists in this case. And if you don't have a deep pocket, you need the likes of the infrastructure funds to support you in terms of your development. We're also seeing, as I said earlier, we're also seeing the support in terms of structuring of your deals to make money, to meet money. We're seeing them able to almost do other introduction to expand your capabilities for offtake. We're seeing them also providing, as I said, early stage support, policy support as well. The Sovereign Wealth Fund, for instance, Nigeria, is constantly liaising with government in terms of policy structuring and all that. So we're seeing that sort of support. But as I said to your first question, more needs to be done. But they have strong capabilities that the markets continue to benefit from. Thank you very much.
Thank you very much, sir. My next question will go to Victor. Regarding risk and mitigating risks from a legal perspective, one critical aspect of bankability is legal and regulatory risks. What legal risks do infrastructure funds typically face in a project, and how is it often mitigated?
Thank you, Susan, and thank you for the Coronation team for hosting this webinar, which is quite timely. You will see that there are already a lot of questions in the Q&A box, so it shows how very important this topic is. On issues of risks, I'll just continue from where Chido stopped. So I'm not going to talk specifically on just legal risk because all the risks are intertwined and there are legal ways to take care of them in your drafting. So he had already talked about the difference in the risk profiles of green projects and brownfield projects. And when you talk about risk, most times it's really with a focus on greenfield projects because brownfield projects already have a track record. The construction is already done, which is one of the most critical risks. So I will step back a little because I know that we have a mix of audience. So I will just explain bankability so everybody is carried along. In just briefly speaking, bankability is making a project attractive for investors or financiers to fund that project. So to ensure that the project is as much as possible de-risked or the risks are well mitigated. So the key risks that you will see in a typical infrastructure project are construction risks, So the risk that the project may not get to construction. And why this is important is, unlike your normal financing or corporate financing, funding an infrastructure project relies on the revenue generated from that project to pay back the investors. And so if the project is not completed, it means nobody gets paid. So that is it's one of the key risks in infrastructure projects. You have operating risks. So you've completed the project, but the operation is not well managed, and that affects revenue. At the heart of all this risk is cash flow, because the key thing is the project has to be well managed, that the cash flow is not interrupted. There is enough for the fund to pay the coupons that are due and pay back the investors. Market risk is a risk that most of us are aware of, whether there is a market for the project and pricing. But Mayowa had already talked about most of these projects being inflation proof, because in any case, they are essential projects that we need to move forward. You have your off-taker risk and political risk, whether the project is going to suffer any form of, radical change of law that could affect the project, or expropriation. Now, in managing the risks, what the funds look for, and what, from a legal perspective, what we try to do is to make sure that there is a term that we often use in infrastructure projects, that risks are best allocated to the parties best able to handle them. So you have to make sure that in your legal documentation, a typical infrastructure project can have anything from 3 to 10, over 10, 20 agreements cutting across different parties, from the financiers, the project developer, the EPC contractor, the O&M guys. You have to make sure that those risks are well allocated, and where necessary, the risks are passed on to the parties that are best able to handle them. So in doing that, you ensure that from the beginning, all these risks are taken care of. I'll give you an example. Construction risk, which is the key thing that we've talked about. In your typical EPC contract, you want to make sure that the contractor, being the person that is going to construct the project, bears completion risks. And therefore, you build things like delay liquidated damages to motivate the contractor to complete the project on time. And if they don't do that, they pay delay liquidated damages. You build in provisions that will enable the fund and the investors to step in and get a third party to complete the project at the cost of the EPC contractor. You require things like advance payment guarantee, where the EPC contractor is going to be paid in advance. You require things like performance security to make sure that the project, when it's completed, actually performs up to the required capacity. For O&M, similar provisions to take care of operating risk in your O&M agreements. For counterparty risk, an example, for off-taker risk, you may need to include payment security, right, to ensure that there is no interruption in cash flow. Then the big one, regulatory risks. Some of the ways we document the mitigants include, getting some form of political risk guarantee. And then in some cases, I've seen that in some cases, bringing in a DFI to co-lend or to co-fund a project could be, a discouraging factor, could discourage the government from taking certain political actions that could negatively impact the project. So those are the things that the funds look out for in negotiating their contracts together with their legal partners, to make sure that the project is completed, starts generating revenue, and all the investors are paid.
Thank you very much, Victor, for that very detailed, robust answer. I'm going to just take the next question to Mr. Bolaji. Okay. Given your significant experience in the energy sector, how has Nigeria's recent economic and political environment affected the ability of projects to reach financial close?
All right, thank you very much for that. I guess a few things. The biggest one is the policy mismatch that has been created as part of the economic downturn. That has very much affected for projects, for instance, who were very much priced in USD dollars. We've seen arrangements where a project, if it was a $10 million project, for instance, a few years ago was what, 17 billion naira, 150 or 15 billion naira, or 15 million naira, I should say, 1.5 billion naira, sorry. When the economy started having its issues, you needed more naira to achieve the same dollars, which meant that developers would have to approach more lenders, knowing fully well that the lenders have what you call the single obligor issues, wherein they can't lend more than a certain amount of money to a developer. Let's also remember that the commercial lenders will usually almost take a back end, wherein they don't want to go in first in on projects. So having to raise more money from them, you then needed to have more lenders being arranged together, creates all sorts of syndication issues for you. It also creates issues for your cost of debt, wherein cost of money on the debt side of things sort of moved up from the likes of the 18%, 20% money. At some point, we started seeing 32% money in the market, even as fast as high as 35% money. 35% money if you have a construction period of 16 to 18 months, you've almost raked up about 70% cash, which you then have to provide for in what you call interest during construction, which usually be provided for in terms of the equity provider's cash and the bank to give comfort to a lender. So that itself is another obstacle created by the market. It also affected costs of equity as well, as the market, the providers of equity will look to have a higher rate of return on the cash coming in. It also then expanded the planning horizon. Projects that were supposed to go in for 3 to 4, 5 years planning period then got extended. In other words, regulatory changes, for instance, energy projects that had the old DPR being involved, then after of course, the part of the PIA then had 2 separate agencies, wherein you have to go to one agency for one approval and another agency for another approval. That change, which was a very good change actually, eventually. But again, it just sort of extends your planning and development horizon. That also the issue of the downturn in the economy also affected what I spoke about earlier, which is the availability of pre-development capital. You need cash for setting up your SPVs, screening your EPC, screening your O&M, offtake agreements, legal, commercial, financial, community, regulatory. All of that cash, when the project is extended, you need more cash to run the process. You have staff, you have logistics, travel. That downturn kind of extended that process. It also made it more difficult for the market for you to raise more cash. Created all kinds of issues for your pricing of your debt as well, which then meant that your debt service cover ratio, which the lenders will look at depending on who you're talking to, sometimes 1.3, 1.4x, 1.5x, you needed to show more in terms of headroom to give a would-be lender additional comfort. It also affected, of course, the country risk premium, which then meant that a country risk premium was an additional premium for a would-be investor coming in from outside the country, and that just speaks to all sort of issues for you and for your pricing as well. So I guess all of that created more difficulties for developers in the market. We're seeing a bit of risk spike now. Of course, there were FX issues as well. There were issues around the clarity around subsidy, where things were going. We've kind of seen a bit of a balance in the market today, or at this point, which wasn't there, what, 4 years ago. That is giving a bit of respite to the people. But all those issues were there. It created all kinds of pricing issues, long-term issues for the development, cost of money, country risk premium, even in terms of even sovereign issues being around the volumes of crude oil being produced and at the price as well, to be able to meet all that sorts of obligations for the government, which then affected the volume of cash in the economy. So the downturn created all sorts of things. I think that we've seen an upturn in the market quietly, being encouraged, of course, by the more institutional funding that are designed to support the kind of projects that we're looking at. Those things were not there 3 years ago, 4 years ago. But because of all of the things we're seeing in terms of the support from, again, the infrastructure funds, the funds designed specifically to help our types of projects, we're beginning to see a place to play around with. But again, let me just wrap this up here. We'd like to put everything under pricing of your projects. The pricing of projects became more expensive as the economy had other issues, and of course the tenure for development became more extended as well, and that also affected the amount of cash you required to get involved in your pre-development work. So all those mismatches and all those economic issues, we can price them into your credits, your cost of your project. Cost of project development overall increased significantly, but it's much better these days. Thank you.
Thank you very much, sir. Victor, my next question will be to you. How do legal firms like UBU support infrastructure funds in structuring and then executing transactions?
So I would say that we support on two fronts. So our firm, we are essentially a full service law firm. So we have a capital markets team that can support infrastructure funds when they go to market to raise funding. And then we also have a robust projects development and financing team that also support the funds for investing in projects as well. So on that front, we support end to end. We can come in at the very early stages. We can also come in after the project has been identified, and we can start from the very point of due diligence. We assist with due diligence for the purpose of identifying any legal risks that the project may face, and then propose mitigating measures. So, taking you back to the project risks that I had talked about. So it's at this point when we look at the contract that the project developer or the project entity has already executed or is negotiating, we then propose amendments or changes to make sure that these risks are taken care of. And that's where you have things called conditions precedent before financial close, that the project developer has to make sure these things are done before the funds can put in their money. So the fund doesn't just identify a project and put in their funds. We also assist the funds, obviously, in negotiating the financing documents from the term sheet phase to the facility agreement, the security documents necessary to take security over the project assets to ensure that at least the fund has the ability to enforce where necessary. But as I already mentioned, what is really important is that at the early stages, any risk that could even lead to enforcement is identified, mitigated, and just have those security documents as your last resort, because the intention is to ensure that the project comes online and starts generating revenue. We also assist in negotiating the project documents. We make inputs in the project document between the project company and their counterparties to make sure that the terms are favorable and practicable. And then we also support them well up until the end of the financial close, post-financial close, and then sometimes even until the project comes online. And for us, that's really the most important part of it, when you advise on a project and then you see it come online.
Okay, thank you. So let me just add to that. I'm glad that you brought up security. What are the different types of security that lenders like infrastructure funds can have over a project? And in your experience, how successful is the enforcement of this?
Okay. So generally in Nigeria, depending on the asset, right? Generally in Nigeria, most projects, the typical structure of a security arrangement often involves security over land, real estate, where the project is sited. So that will be under your deed of legal mortgage. You also want to have an all assets debenture that is a catch-all for all the assets of the project, both the tangible and the intangible. You want to have security over the project accounts. One thing that you must do, and we ensure that is done in an infrastructure financing, is to make sure that the cash flow is tightly controlled with sufficient flexibility to not stifle the activities of the project company, but make sure that there is clear line of sight on the cash flow. So you have accounts charge either in the all assets debenture or a separate document that takes charge over all the project accounts. Part of what we also ensure is that, and this is to also ensure that that the fund is properly secured, that the project company does not have any accounts other than those approved project accounts, and that the approved cash waterfall in the financing document is maintained right from when money flows into the collections accounts to the various accounts. And one of these accounts is typically a debt service reserve account and a debt service account, to ensure that the project company makes advance provisioning for payment of principal and interest that are due in the near future. We also want to have an assignment of the assignment by way of security of the project contracts. And this gives you the fund the right over the receivables from those projects. One other thing that we try and ensure that is always present is a direct agreement. Now, a direct agreement, let me put it this way, under Nigerian law, common law, anyway, there is privity of contract. So most times in the project documents are between the project company and the counterparty, the construction contractor, the O&M, that's operation and maintenance contractor. So what a direct agreement is a tripartite agreement involving the fund, the project company, that's the borrower, and the counterparty. And it gives the funds the right to step in at any point the project company is failing in its obligation. The reason this is necessary is to ensure that counterparties don't, have the right to enforce their rights at any point during the project. Because if you have a project where counterparties keep enforcing right for breach of any obligation by the project company, that project is going to run into several issues. So you have that direct agreement, and it enables the fund to step in, remedy anything that the project company has, any breach that the project company has committed at the cost of that project company. It also has provisions that ensure that the counterparty does not take any enforcement action without first giving the fund the right to step in. So as you can see, it's a very robust arrangement to ensure that the interest of the fund is well protected. Now, with respect to enforcement, right? How successful you are at the point of enforcement starts from how you structure and how you draft your security documents. So what you need to do, what we do, is to make sure that you have your guns loaded. So if you have a share charge, you don't wait until there's a breach to start getting share transfer forms signed. You don't wait until there is a breach to start getting the project company to execute a resolution, right, for the transfer of shares. You have all these documents prepared and signed by the project company, but they will remain undated, so that at the point of enforcement, you can quickly date the agreement and enforce them. The reason this is important is, as much as possible, we try to limit having to go to court, because from the point you get into the Nigeria, all of us know how, unfortunately, how slow the court system in Nigeria can be. And from the moment you step into the courtroom, already you already have a big problem. So as much as possible, we try right from the point of contract drafting and negotiation to make sure that you have all your ducks lined up, so that if you need to enforce, you can quickly enforce without having to go to court. Because if you go to court, then people start coming up with injunctions, interim injunctions, to try and slow down the enforcement process. So, sorry, a short answer is enforcement is quite effective depending on how you structure it from the get-go.
Thank you very much, Victor. So my next question will be to Mayowa. As a fund manager, what gaps have you identified in the Nigerian gas sector, and the opportunities that exist to unlock additional investments in the sector?
Okay, thank you, Susan. So I will just try to make it brief. There are gaps in the sector, even in as much as we have a very large gas reserve, but however, which is the sector Mabalaji plays in. We've seen quite a lot of players now come into this space, right, to take on projects and let us start getting maximum value from these gas as against flaring it away. But the gap, financial gap, which is what we are trying to solve by investing in some of these projects. Insufficient infrastructure also still exists. And what do I mean? So yeah, you're building a gas plant somewhere. How do you then transport these gas plants to the retail, to the end users at the end of the day? So there needs to be pipelines. We are using trucking. How many trucks do we currently have in the country and stuff like that? Then I think finally that I would like to just add policy execution. So these are gaps. However, in little bits, these gaps are being solved. But we are very happy that we are also part of institutions helping in reducing the gaps in this sector. Thank you.
Thank you. As we wrap up, I just want to take a few questions on sustainability before we take questions from the Q&A box. So Chido, just a quick question on sustainability. How do you define sustainability investing in the context of emerging markets like Nigeria? And what is the business case for embedding sustainability into infrastructure projects?
Hi, Susan. Apologies, trying to unmute myself. So we look at sustainability as responsible investing responsibly, right? That's in summary what you call sustainability. On our end, InfraCredit is very big on ESG, environmental, social, and governance. I think it underpins our overall outlook on any project. We need to be sure that the project sponsors are developing the project in a manner that is environmentally sustainable. On a social standpoint, you want to ensure as much inclusivity as possible. Nigeria has a population of nearly an even split between male and female, and to a large extent, you do not want to limit your workforce to male solely. There are also growing concerns around child labor. You don't want at the same time to expose the next generation to unacceptable labor practices. These things come together into what we consider sustainable, right? The project has to be beneficial for the current generation as well as for the future generation. I think that's a summary of how we see it on our side, and I'll stop here. Thank you.
Okay, thank you very much, Chido. Mr. Bolaji, since you are in the oil and gas sector, what common sustainability projects do sponsors typically adopt in the energy sector? Oh, I think you're muted.
Thank you very much. I apologize for that. There are quite a few things that the energy sector sponsors are beginning to adopt. In our case, we've looked at, again, for us, gas flare reduction capabilities, wherein we are focusing on the environment and essentially reducing pollution and converting what we have in terms of gas flares, particularly into domestic use. And of course, just ensuring that there are, conservations arrangement for water output from our plants and from what we're looking to do. And of course, and how that relates to the environment and the health of the people of the environments where we work in. In terms of social parameters, we're also ensuring that we have a sizable mix of people from all walks of lives and gender to ensure that there is sufficient balance. In our case, even just right from the board, our business board, we've just ensured that there's an equal balance, sufficient amounts of male and female, and from various walks of life to be able to balance contribution. Even in terms of social arrangements, to ensure that people are brought in not just from where we sit in terms of business operations, but even in terms of locality where we operate as well, to just give a sufficient balance for our ESG policies. We've seen that on the back of what our credit support providers are looking at, and even in terms of our investors and even our lenders as well. So that has informed how we are shaped, because if you're not properly arranged, they are less likely to be able to support you. So yes, we are contributing in that regard. Water management, gas flare management, ensuring there's a social balance, there's a gender balance as well. And of course, all of that have economic, social, and environmental benefits. Economic benefits in terms of cost reduction, because we're literally converting the gas flares into energy use. There's cost being used elsewhere, and the reduction in diesel operations, the reduction in even the cost of operations of the businesses that we'll supply into. The issues around, it also gives us, wherever our customers are, competitive advantage from having looked at a flare opportunity. There are also issues around, of course, a healthier environment. If you adopt a strong sustainability policy, the issues around social balance as well, because essentially, just imagine social balance from the community where we operate, where the temperature levels are very high because of those gas flares. The youth issues around these communities, taking those flares off the market, and balancing the composition of the people within your team, the environment, the health, the support, all of that sort of the areas where we are focusing on. And we're focusing on those areas based on the guidance provided to us by the funds and the credit support groups that we're working with. Thank you very much.
Thank you very much, sir. And just to wrap up, so my last question will be to you. I'm looking ahead. How do you see the infrastructure funds evolving over the next 5 to 10 years in Nigeria? And what are the upcoming plans that you would like the audience to take away from today's discussion?
Okay, thank you once again, Susan. Next 5 to 10 years, first, I see the infrastructure funds having a larger AUM, which alludes to the fact that Mr. Abalaji mentioned earlier, that the local infrastructure funds are not able to participate much more in projects currently. So I perceive the next 5 to 10 years, larger AUM, as many of these funds that have raised additional series. Next 5 to 10 years also probably improved financing structure as we understand more project dynamics and also working with more project sponsors. Definitely would start visibly seeing the economic impact of the project. Most of the funds are now investing in, because currently some of them are at various stages. Some just being concluded, some close to completion. So within the next 5 to 10 years, we would start seeing the actual impact that these projects are bringing to the various sectors they're operating in. Then what should you expect, or what are the plans, upcoming plans of the fund? First, I would say I mentioned in my presentation that we are done Series 1. So our Series 2 is imminent. It's coming out soon. The team is working hard on that. And also, we are investing in more projects, or engaging more project sponsor, and continue to build our pipeline. And then lastly, just to mention, the Series 1 currently listed on the exchange, open to various investors to invest. And the Series 2 would also be listed on an exchange, which opens up for more liquidity. Thank you, Susan.
Thank you very much, and thank you to all our panelists. Sadly, we won't be able to take any questions from the Q&A, but we will make sure that they are responded to. We have everyone's email addresses, so we'll respond to all of them individually. And we'll also send the keynote presentation that was done earlier. So now we would like to close. I would invite the Chief Operating Officer at Coronation Asset Management, Mr. Yemi, to give us the closing remarks.
Thank you very much, Susan, and thank you to every one of us, that have taken time to attend this webinar. So as we draw a close to this insightful webinar, I would like to extend a heartfelt thank you to each one of you for joining this important conversation on exploring infrastructure funds as an alternative investment opportunity. Your time and engagement mean a great deal to us. Today's discussion has not only reinforced the huge infrastructural gaps that exist within our developing economy and the various solutions being put together by investment professionals to bridge the gap. The discussions have also helped us to understand how infrastructural development can unlock sustainable growth opportunities that powers our socioeconomic needs, in addition to how individuals and institutions can take advantage of investment opportunities that arise from infrastructure investments. We therefore hope you're leaving with practical insights on how infrastructure funds can support your portfolio diversification and long-term value creation needs. A special thank you to our distinguished speakers, our own Mayowa Ikotun, the head of Coronation Infrastructure Fund, Mr. Victor Samuel, the managing associate of Udo Udoma and Belu Osage, Mr. Chido Oyelimba, head of origination and structuring at InfraCredit, and Mr. Abolaji Femi Shola, the chief executive of Tranergy & Co. It is not common to have people with diverse and well-experienced background be in the same room as often, as we have made it possible for you guys to be here. Your perspective has brought clarity to very, very complex topic, and it has helped deepen our collective understanding of the opportunities within the infrastructure and investment landscape. To our moderator, Susan Owoduni, thank you for expertly guiding today's thoughtful and engaging discussion. And most importantly, to our audience, we thank you for your active participation. Your curiosity and commitment to learning continue to inspire us to create platforms like this, where knowledge drives opportunity. As you leave today, remember, every great nation is built on strong and sustainable infrastructure, and every great portfolio can be strengthened by infrastructure investments as well. So for more information about the Coronation Infrastructure Fund, please contact us at CIF_info@coronationam.com, which I believe is also displayed on our screen. Thank you once again for being part of this conversation, and have a wonderful afternoon. Thank you.
Thank you very much, everyone. And please, for your further inquiries, the email is on the screen. You can send us an email and we'll be sure to reach out to you. Thank you, everyone, again for attending, and enjoy the rest of your day.
Thank you.